Good afternoon, friends. I think RegTech study group today have lesser attendance because of maybe incoming festival. The pollution festival is going on. Ganpati festival is there, and today also there are other two study group meetings hosted at 3:30 and 4 p.m. So probably because of which we have lesser attendance. Nonetheless, the topic is very apt. Day in and day out, there are various judgments which keep coming, and we have seen some of the very good judgments which have come recently. And we thought this is, such wonderful topic to have recent judgment about the various judiciary pronouncements which have come into the tribunal, High Court, Supreme Court. And we requested Shekhar Patwardhan sir, and sir was kind to prepare for this study group meeting. And he has been our regular faculty. He has been one of the core support to WIRC, be it our reference manual, the book, be it various topic in income tax. He's always one such person who is available, who is supportive to us. So I place on record sincere thanks to Shekhar Patwardhan sir for being always available, being there. And just to offer a small memento, I will request her to accept a small memento from our side. This may I request C.A. Shekhar Patwardhan sir to start this session.
Good afternoon, everyone.
Good afternoon.
The respected chairman WRC and the study group members. So basically, I very much like this concept of direct tax study group. So many judgments are coming real time, and really we need to keep ourselves updated. So next maybe 2 hours or so, what we are going to do is, as it's a study group meeting, we will jointly study the various judgments. How many of you are practicing in litigation?
Compliance practice.
Okay. So actually, litigation is a great area of practice, because every now and then we are looking for new avenues, new areas, and I feel this is one area of practice where there is a tremendous scope actually. And another important aspect is, as far as the litigation is concerned, if you see the pattern of the judgments, the pattern in which the litigation is happening. So again and again, the litigation is happening on particular sections. So on a particular case, if you have a ready submission, then next time, if same type of case comes, then your submission is almost ready. And that is the beauty of the litigation practice. Now the challenge here is the artificial intelligence actually. Today I'm reading the newspapers, and sir, I read that now the robot has come, which can prepare 150 Indian preparations in food. So वो मम्मी के हाथ का गाजर का हलवा, that concept also now I don't know what is going to happen. As far as the field of litigation is concerned, they say that now the taxman is itself coming with a publication where if you submit the assessment order and if at all it is a tribunal, then CIT appeals order, then you will get the ready submission for the appeal. So, AI, I feel, is the greatest challenge as well as the opportunity for all of us. So, with this background, let us start. Let us coming to the topic. So, today I have selected 14 various judgments on different sections. So what we are going to do is, instead of presentation, I am going to read, and jointly we are going to study the actual cases, actual judgments, I mean, not from the PPT, so that we will understand how the courts have interpreted the various sections. So, starting with the Aradhya Jain Trust, the issue of surcharge, section 2, subsection 29C, and like that, 14 different judgments we are going to analyze, and these are the sections which are of our day-to-day use, day-to-day importance. So even though you may not be into the litigation practice, so still I feel these judgments will you will feel that they are very relevant and very apt. So, as I said, starting with the first very interesting case regarding the interpretation of the maximum marginal rate. So, the issue is about the maximum marginal rate. So, as you all know, basically this particular judgment, it deals with section 2 subsection 29C and the section 164. So these are the sections. Basically, section 164, it says that as far as the private discretionary trusts are concerned, where the shares are not determined, they say that tax has to be levied at the maximum marginal rate. Now, what is the exact meaning of maximum marginal rate? So, maximum marginal rate is defined in section 2, subsection 29C. So let us go through what the section 2 subsection 29 says about the maximum marginal rate, because the whole litigation is on this interpretation of the maximum marginal rate. So I am reading from the act. So section 2 subsection 29C, maximum marginal rate means the rate of income tax, including surcharge of income tax, if any, applicable in relation to the highest slab of income in the case of an individual, into bracket AOP, or the case may be body of individuals, as specified in the Finance Act of the relevant year. So as far as the rate is concerned, there is no doubt that as far as the income tax is concerned, the income tax has to be levied at the highest slab. But the issue is whether the highest rate of surcharge also will be applicable or not. So the Mumbai Tribunal first came with a judgment on 7th of October 2024. Now, I'm referring to the judgment delivered by the Mumbai Tribunal on 7th of October 2024. And that 7th of October judgment, it said, the policy of law as suggested in section 2 subsection 29 of the act is to discourage discretionary trust by charging the income of such trust in the hands of the trustee at the maximum marginal rate, except in certain specified situation. ITAT observes that if assessee's interpretation is accepted, then the word surcharge in section 2 subsection 29 becomes redundant. Then it refers to the commentary on the income tax by Chaturvedi Pithacharya, as well as the book published by Vinod Singhania, and observes that when assessee is to be taxed at the maximum marginal rate, same is to be arrived at by taking highest slab of tax and highest slab of surcharge applicable in case of the individual. Thus, it rejects the assessee's argument that the rate of surcharge applicable to assessee according to the income slab of the assessee and should not be at the highest rate of surcharge provided in the Finance Act. It also rejects the assessee's argument that CPC does not have any power to vary the rate of surcharge by processing the return of income in section 143(1), by observing that CPC has power to compute the correct amount of tax and sum payable by the assessee in terms of the provisions of 143(1)(b) and C. So this is what the judgment said. Then let me tell you a story regarding this. See, a case came to us. Same issue, means whether the highest rate of surcharge has to be applicable or not. When this case came to us, at that time there was only one tribunal judgment of Hyderabad Tribunal, very old judgment of 2003, which says that as far as the surcharge is concerned, the surcharge has to be as per the slab and not the highest rate of surcharge. So with that, I happily accepted that case, thinking that no other tribunal judgment is available, and I have one favorable judgment with me. But later on, this Mumbai tribunal judgment came, and with this particular judgment is coming, which categorically is saying that basically the surcharge also has to be charged at the highest rate. And that is why I felt now everything is lost. So I told the client now, at that time the VSVS also, Vivad Se Vishwas was also going on. So I said, let us explore that. And in that context, we took adjournment later on. So, for me, it was a like absolutely lost case where the jurisdictional Mumbai tribunal is saying that highest rate of surcharge has to be applicable. But then, after some days, I came to know that the Mumbai tribunal has formed a special bench. And then again, I took an adjournment saying now that special bench has been formed. So let's say what the special bench says. So in the same case, this is what the beauty of the litigation practice. Now, whatever I read, same Mumbai tribunal, just after 6 months, they took a 180-degree, different view altogether. So this is what the special bench judgment is about, and that we are referring. A very important judgment for all of us, which talks about again about the surcharge. So now coming to that special bench judgment. So as far as the special bench judgment is concerned, as I said, what I always feel is, we should read the judgments carefully, because they give us the what exactly the court want to say. So that is why instead of referring to the PPT, whatever case summary is there is anyway given in my presentation. But now what I am doing is I am just reading from the judgment. This is, as I said, this is a special bench judgment delivered on very recently, 9th of April 2025. So in case of discretionary trust, sections 164 and 167B of the Act do not themselves specify the rate of tax. Now just listen what the tribunal has said. They only say that tax on income is to be determined at the maximum marginal rate. The definition of maximum marginal rate under section 2 subsection 29C of the Act in turn refers to the rate of income tax applicable to the highest slab as provided under the Finance Act of the relevant year. Thus, for determining the maximum marginal rate of tax, one has to revert back to the rate prescribed in Part A, Part 1 of first schedule of the Finance Act 2023. Subsection 2, Section 2, Subsection 2(1) of the Finance Act further provides that tax so determined shall be increased by a surcharge collected for the purposes of union, calculated under each case in the manner provided in the first schedule. Now, as we all know, the first schedule basically talks about the rates of income tax, and then later on the surcharge on income tax. So it further says, on going through this paragraph, means paragraph about the rates of tax of first schedule, it becomes very much clear that under Atom 1, the rates of income tax applicable to individuals, Hindu undivided family, or association of persons of body of individuals have been provided. Then further they are saying the expression slab is not mentioned either in subsection 1 of subsection 2 or even in paragraph A. However, as per the materials placed before us, it is observed that press note dated issued by the Government of India, copy of which is placed on record, slab refers to income and not the tax. In fact, even section 2 subsection 29C of the Act refers to the highest slab of income. Then explanatory notes to provisions of the Finance Act, a copy of which is placed, refers to the slab to the various categories of income. Thus, in terms of 164 and 167B of the Act, as per the maximum marginal rate would mean the rate of tax applicable to the highest slab of income under Atom 1 of paragraph A of the first schedule of the Finance Act. Then, under the surcharge of income tax appearing, it has been provided that amount of income tax computed as per the rate of income under 1, 2, and 3 or under the provisions of 100A or section 112 or 112A shall be increased by a surcharge for the purpose of the union calculated in the case of particular class of assessees in the manner provided therein. So ultimately, what it is saying, therefore, levy of surcharge has to be preceded by a law enacted by the Parliament authorizing such levy. Thus, in the absence of any law authorizing levy of surcharge, it cannot be collected. This legal position, with this legal position, it is as clear as daylight, hence does not require further clarification with the use of the words if any to mean whether the Finance Act of a particular year, if at all, provides the levy of surcharge or not. Thus, in our view, the expression if any used in section 2 subsection 29C has to be read not dehorse but in conjunction with the computation mechanism provided under the heading surcharge of income tax provided in section 2 of the Finance Act. This view of ours is further fortified by the object for which the levy of surcharge was introduced by the Finance Act. So with this, ultimately they are saying, in ultimate analysis, we hold in case of private discretionary trust whose income is chargeable at the maximum marginal rate, surcharge has to be computed on the income tax having reference to the slab rates prescribed in the Finance Act under the heading surcharge on income tax appearing in paragraph A, part 1, first schedule applicable to the relevant assessment year. So with this, the tribunal is coming to a conclusion that basically surcharge has to be levied as per the slabs of income and not the highest rate of surcharge. So it sounds, if you consider, if you look at, it will look that it's a small issue of surcharge. But let me tell you that surcharge makes a lot of difference as far as the amount of taxes are concerned, because the highest rate of surcharge is 37%. And if you compute as per the income slabs, see in Mumbai, there are so many private discretionary trust formed by the corporates, where it has a huge impact as far as the surcharge is concerned. When the surcharge is levied as per the slabs of income and as per if it is calculated as per the highest slab, huge amount of tax difference is there, and that is why this particular judgment, a very recent one by the special bench of the Mumbai Tribunal, is very, very important.
They hold the Hyderabad tribunal judgment.
Yes. And they reversed their own decision, which was just 6 months back. Just 6 months back.
Special matlab to judge.
Three bench, three judge. Special bench is basically three judge bench, and that three judge bench, unless High Court judgment is there, that three judge bench is applicable to all over India.
So they form according to their comfort. We are applying for that.
Sometimes we are applying for that, and if the conflicting judgment comes from the various tribunals on this issue, the conflicting judgments came from Hyderabad Tribunal, then Bangalore Tribunal, and then even Mumbai Tribunal. So that's why they decided to form a special bench to decide on this particular issue, and to the assessees' surprise and to our surprise also, they reversed their own decision just in 6 months. So moving on to the next judgment, and that is again about the reopening, that is section 148. So when it comes to section 148, always we talk about the Ashish Agarwal, and we also discuss about the Rajiv Bansal. So Ashish Agarwal and Rajiv Bansal, everybody is aware of Ashish Agarwal and Rajiv Bansal, or shall I explain you in a few minutes? Okay. So the issue of 148 reopening, the new law came into existence from 1/4/2021. The new set of law as far as 148, it came into existence from 1st of April 2021. And at that time, the COVID was going on. So because of the COVID, department could not issue the 148 notices. And that is why they give an extension for issuing the notice under section 148. And they gave the notification, they gave the extension for the period 20th March 2020 to 31st of March 2021. They gave the extension. But meanwhile, they forgot that on 1st of April 2021, actually, the new law came into existence. So they keep on giving the extension, but they forgot that on 1st of April 2021, the new law came into existence where the set of provisions were completely different from the old law. So that is why, although from 1st of April 2021, new law came into existence, the officers issued the notices of 148. Although the new law was in existence, they issued the notices as if they were as per the old law. And this is all over India. This is what happened. And that is why so many writ petitions have been filed in various high courts. And all the high courts said that basically this is wrong. When the new law has already came into existence from 1st of April 2021, you cannot issue the notices as per the old law. So this is what the high courts said. Various high courts in the country have said. And that matter went into the Supreme Court. And then in Ashish Agarwal, the Supreme Court said ultimately, obviously the notices issued were void ab initio because they were issued as per the old law, which was not at all in existence as on 1st of April 2020. But still, considering, see, it was a huge, I mean, the notices, the impact, the tax impact was huge. And that is why the pressure obviously was there on the Supreme Court as well. So that is why what the Supreme Court said in Ashish Agarwal, although those notices have been issued later on, but still we consider them as valid, although they were invalid. But they said whatever new set of law that is there, that is the new law, that new law says that basically you have to give information to the assessees why you are reopening. So the old set of provisions were different. In new set of provisions, it is they are supposed to give the information. Then based on that information, the assessee gets an opportunity. It's like a show cause notice where they get an opportunity to explain their case. And then if at all then needed, then the assessing officer issues actual 148. So this is as per the new law. So what the Supreme Court said, okay, fine, you have issued the notices, but then you have to comply with the new law as well. And this is what the Ashish Agarwal is all about. So although all the notices issued in 148 were invalid, but they were termed valid by the Supreme Court. This is what it has happened in Ashish Agarwal. Then later on, the judgment came about the Rajiv Bansal. So basically, Rajiv Bansal explains us the mechanism, how this actually will work. Because as I said, the assessing officers, they are supposed to give the information to the assessees, and then they are going to respond. And for that, the time periods have been specified in the new law. So how that actually is going to work, that is what is decided. That is what those directions have been given in the Rajiv Bansal's case. So basically, one must understand that whenever it's an issue of 148, always the date of issue of notice, as on that date, whatever law is prevailing, we have to consider the law as on that particular date. Okay. And another thing which we need to keep in mind is whenever that period was expiring between 20th March 2020 to 31st of March 2020, that is a peak COVID period. where the officers could not issue the notices, there they have given the relaxation. Okay. So with this background, now let us understand the mechanism. First, before going into this Mumbai ITAT judgment in case of SKF Limited, I think it is better let us read once what the Rajiv Bansal says, and then after reading the Rajiv Bansal case, we will come to the SKF Limited. So extension of time limit by operation of Taxation and Other Laws Act. So basically we call it as TOLA. Section 149(1) of the new regime is not prospective. It also applies to past assessment year. Provisos to section 149(b) specifically refers to the time limits specified under 149(1)(b) of the old regime. Use of the expression any in section 3 subsection 1 of TOLA indicates that the relaxation applies to all or every action whose time limit falls for completion from 20th of March 20 to 31st of March 21. Amendment or substitution of a provision under the specified acts will not affect the application of TOLA, so long as the action contemplated under the provisions fail for completing during the period specified by TOLA, that is 20th March 20 to 31st of March 21. Relaxation provided will apply to the issuance of a reassessment notice under section 148. TOLA, now this is important, TOLA did not amend the time limits of 4 years and 6 years from the end of the relevant assessment year as specified under the Income Tax Act. Although TOLA did not amend 149, it has to be read with section 149 to determine the time limit for issuance of a notice. Notifications dated 31st of March and 27th of April extended the operation of TOLA by providing an extended time limit for completing the actions under the Income Tax Act till 30th June 2021. Section 29th of Section 2 subsection 1B of TOLA must be read to mean the IT Act as amended by the Finance Act 21. Substituted of 147 to 151 will not affect the purpose of TOLA. Therefore, for issuing a reassessment notice under section 148 after 1st of April 2021, revenue would still have to look at the time limit specified under section 149 of the new regime and the time limit for issuance of a notice as extended by TOLA and its notifications. Time limit for issuance of a reassessment notices which fail for completion between 20th of March and 31st of March has been extended till 30th June 2021. So basically this extension was given till 31st of June 2021. Now let us analyze it from the presentation. So if you look at the presentation, actually it is the analysis is there from the assessment year 13-14 to assessment year 17-18. So basically, what is the time limit? The time limit as per the law, that is within 3 years and then within 6 years. So we are analyzing the assessment year 13-14 to assessment year 17-18, whether the notices issued by section under section 148 whether valid or not. So within 3 years. So as far as the assessment year 13-14 is concerned, so see, the time limit is 3, either it is 3 years or 6 years, either it is 3 years or 6 years. Now as per the new law, that is effective from 1/4/2021. So if you take within 3 years, assessment year 13-14 is concerned, the time expires on 31st of March 2017. So the extension that we are talking is for the period 20th of March 2020 to 31st of March 2021. So whether this 31st of March 2017 falls within that duration, the answer is no. So that's why what we are saying is the expiry of limitation read with TOLA, the TOLA is not applicable. Now, if you consider it for 6 years, then assessment year is 13-14. If you consider 6 years, then the date comes to 31st of March 2020, which very much falls between 20th March to 31st of March. So that's why for this year 13-14, the expiry of limitation rate with TOLA, it comes to 30th June 2021. So in short, 13-14 is very well covered by the TOLA. Similarly, for assessment year 14-15, so 14-15, consider 3 years, expires on 31st of March 2018. Again, this date doesn't fall in between that period, but as far as 31st March 21 is concerned, it very much falls within that period. So that's why the extension under the TOLA is available till 31st of June 2021. Now this assessment year 15-16 is a very peculiar year. And why it is peculiar? If you consider 3 years, then those 3 years expires on 31st of March 2019. And if you consider the period of 6 years, then that 6 years get expired on 31st of March 2022. So that's why department in Rajiv Bansal's case, they themselves admitted the fact that no reopening can happen as far as assessment year 15-16 is concerned, because the time limit itself is not fitting. So friends, 15-16 is a very peculiar year. Any of you, if you are having a notice of reopening for 15-16, then that notice is void ab initio. This department itself admitted in Supreme Court. And this is what the Rajiv Bansal is all about, where the department admitted the fact that we can't issue a reopening notice for the assessment year 15-16. So as far as 16-17 is concerned, again, it is 3 years, that is 31st March 20. Again, that 31st March 20 falls within that duration. So that is why as far as the 16-17 and again 17-18 is concerned, as far as the initial 3 years period is concerned, that can get covered as far as the issue of 148 is concerned. Now coming back to our case, so these issues keep on happening. So identical issue was there in that SKF limited case. So in that SKF limited case, same, I mean the assessment year is assessment year 15-16. So now in this case, let us understand what actually happened. So notice was issued under 148 for assessment year 15-16 on 29th of July 2022. Notice thus being time barred for the assessment year 15-16, the limitation period available with the assessing officer under section 149 for issuance of a notice under 148 was till 31st of March 2022. And in this case, the notice was issued later on. Similar challenge in respect of assessment year 15-16 has been considered by the Delhi High Court and coordinate bench of the tribunal, and the issuance was decided in favor of the taxpayer by considering the submission of the revenue before the Supreme Court in Union of India versus Rajiv Bansal, where it was conceded by the revenue that for assessment year 15-16, all notices issued on or after 1st of April 2021 will have to be dropped, as they will not fall for the completion during the period prescribed under the TOLA. And the courts consistently considering the submissions made by the revenue before the Supreme Court in Rajiv Bansal have held that reassessment notices issued under section 148 for assessment year 15-16 is barred by the limitation. So this is what has been held consistently by the various high courts and also by the Mumbai Tribunal. So Mumbai Tribunal in this case finally said, we have considered the submissions of both sides and perused the material available on record. We at the outset find that the similar issue pertaining to the challenge against notices issued under 148 for assessment year 15-16 on the basis that same are beyond the limitation period prescribed under section 149 of the Act has been decided in favor of the taxpayers after noting the submissions of the revenue before the Supreme Court in Rajiv Bansal, wherein it was conceded by the revenue that for assessment year 15-16, all notices issued on or after 1st of April 2021 will have to be dropped, as they will not fall for the completion during the period prescribed under TOLA. So this is the case of Escape Limited. Again, a very recent judgment of the Mumbai Tribunal. Now, the next very important issue, our third case, and that is Hexaware Technologies Limited. As far as the Hexaware is concerned, multiple issues were there in Hexaware. So as far as the Hexaware is concerned, again, the Hexaware is a Bombay High Court judgment for the assessment year 15-16. So as I said, just now we discussed that as far as the assessment year 15-16 is concerned, the various high courts in the country have already held that 148 notices issued for the assessment year 15-16 are time barred, and department cannot issue the notices under section 148 for assessment year 15-16. So Hexaware actually is on multiple issues, and one issue was this reopening based on the dates and Rajiv Bansal, and we have already dealt with that particular matter. But Hexaware, we are referring for another very important issue, and that is a very, very burning issue as on date. And that very burning issue is the reopening notices issued by the jurisdictional assessing officer instead of the faceless assessing officer. We all know that the scheme of faceless assessments have started in the country. Now the issue that we are deliberating in Hexaware is, when this faceless scheme is already applicable in the country, whether the jurisdictional assessing officer has jurisdiction to issue the notice under section 148. And this has become a really burning issue as on date. So as far as the Hexaware judgment is concerned, let us understand, first of all, the issue is about the jurisdictional assessing officer versus the faceless assessing officer. So can a jurisdictional assessing officer issue a show cause, even forget about the 148 notice, but even a show cause, whether your jurisdictional assessing officer can do that or not? So the Hexaware is on that. And after Hexaware, now why we are calling it as a very burning issue, after Hexaware, series of judgments have been passed by the Bombay High Court on the identical issue referring to Hexaware. And that is how all those notices which were issued by the jurisdictional assessing officer, the department, Bombay High Court said that all these notices are invalid because they are issued by assessing officers. So let us understand what the Bombay High Court said as far as the issue of the notices issued by the jurisdictional assessing officer. So it says the impunged notice on 27th of August 2022 has been issued by the jurisdictional assessing officer and not by the NAFA, which is not in accordance with the scheme prescribed by CBDT as per section 151A. Guidelines dated 1st of August 2022 are internal guidelines, as is clear from the endorsement on the first page of the guideline, confidential for departmental circulation only. See what department said to High Court, that basically we have been issued the guidelines by the CBDT, by the income tax department. Now High Court is saying those guidelines are your internal guidelines. As far as the law is concerned, you have to abide by the law. If you are not abiding by the law, and if your internal guideline says that the notices can be issued by jurisdictional assessing officer, then that means you are not complying with the law. And that is why the High Court says all these notices are not valid. All these notices are invalid. So the High Court is saying these are internal guidelines, as is clear from the endorsement on the first page of the guideline, confidential and for departmental circulation only. Said guidelines are not issued under section 149. Any such
जो चलता है वो ठीक
अभी तो
था
चल
यार।
रहा था।
किसके था इस पे था कौन सा वाला?
हाँ ये
ये
एक जो था वो स्लाइड वही, वो अभी जो स्लाइड है वही प्ले।
इसमें
Yes. Yes. ये अभी इधर से दिस इज नॉट ऑपरेट नहीं हो रहा।
राइट लेफ्ट
नेक्स्ट। हाँ ये
ऐसा ना पहले अरे पहले
So what the High Court is saying that said guidelines are not issued under Section 119. Any such guideline issued by the CBDT is not binding on assessee. Further, the said guideline is also not binding on respondent one as they are contrary to the provisions of the Act and the scheme framed under 115A. Further, there is no question of concurrent jurisdiction of the jurisdictional assessing officer. And further, there is no question jurisdictional assessing officer and the faceless assessing officer for issuance of notice under section 148 or even for passing assessment or reassessment order. Argument advanced by the revenue on the office memorandum 20th of February 2023 is clearly contrary to the provisions of the Act as well as the scheme dated 29th of March 2022. So further, the Bombay High Court is saying there is no question of concurrent jurisdiction of the jurisdictional assessing officer and the faceless assessing officer for issuance of notice under section 148 or even for passing assessment or reassessment order, which specific jurisdiction has been assigned to the either to the jurisdictional assessing officer or the faceless assessing officer in the scheme dated 29th of March 2022, then it is to the exclusion of the other. To take any other view in the matter would not only result in chaos, but also render the whole faceless proceeding redundant. If the argument of the revenue is to be accepted, then even when notices are issued by the faceless assessing officer, it would be open to an assessee to make submission before the jurisdictional assessing officer and vice versa, which is clearly not contemplated in the Act. And that is the reason that all these notices issued by the jurisdictional assessing officer, the Bombay High Court said that all these notices are invalid. Now, let me tell you This is a very common issue. If you see any notices effectively issued under section 148 in this duration, they are issued by the jurisdictional assessing officer. See, jurisdictional assessing officer issuing a notice under section 148, giving you a show cause, then ultimately, if you know the person who is giving the show cause, then as far as the show cause is concerned, ultimately, when you know the officer who is giving you that show cause, ultimately you can meet that officer and then you can understand what I am saying. So basically, the whole purpose of this faceless assessment scheme is to avoid this. Then what's the purpose? How can then a jurisdictional assessing officer issue even a show cause notice under section 148? And this is what the issue is all about. And as I said, this is a very, very burning issue. Now, as I said, total 700 orders have been passed by the Bombay High Court. And now all those cases are pending in Supreme Court. In Supreme Court, one of the case, the special leave petition of the department, they rejected that SLP, special leave petition, by the Supreme Court. In short, they confirmed the Bombay High Court order, but the another 700 cases that I just referred, those cases are actually pending in Supreme Court. So ultimately, the department said that when that SLP got dismissed, when the SLP got dismissed, the department said that you please tag this with the other 700 cases that are pending with you, and that's why they have filed that particular petition. In short, the matter is still pending in the Supreme Court, and it's a very, very important issue. Now, what the Supreme Court does, ultimately, the fate of so many assessments lies in the hands of the Supreme Court, because again, just like in case of Ashish Agarwal, you can imagine just 700 cases have been formed, writ petitions have been formed filed in Bombay High Court. See, in all the cases that we have gone into appeal, everywhere the notices have been issued by the jurisdictional assessing officer. And first ground we are taking that since the reopening notice is issued under section 148, that is why it is invalid as per the judgment given by the Bombay High Court. So again, as far as the Supreme Court is concerned, just like in case of Ashish Agarwal, the stakes are absolutely very, very high. So pressure is there on Supreme Court as well. If this particular matter gets decided in favor of the assessee, then so many notices issued under section 148 will become invalid. And that's why I said it's a very, very important and a very, very burning issue, this Hexaware and the issue of jurisdictional assessing officer versus the faceless assessing officer. So this matter is still pending in the Supreme Court, and we are awaiting the decision of the Supreme Court. So ultimately, finally, whatever Supreme Court said, the fate of the assessments and appeals will be decided by the Supreme Court order. So let's see what the Supreme Court does in this particular matter.
So, sir, right now 148 notice should be issued by FAO.
Yes, I mean, as per the scheme, even basic show cause, and then ultimately the order which they pass, and then they issue a notice under section 148, that entire process has to be done by the faceless assessing officer. Now, the issue that we are discussing is whether the ZAO and FAO, whether they can have a concurrent jurisdiction, whether two officers can have a jurisdiction over your case, that issue that we are deliberating. So as far as the Bombay High Court is concerned, we just discussed in Hexaware what the Bombay High Court said. But the other high courts in the country, the Chennai High Court and the Madras High Court and the Delhi High Court, they are saying that the faceless assessing officer and the jurisdictional assessing officer can have a concurrent jurisdiction. So that's why the high courts are also not in one line. The high courts have a different view. So that is why, now ultimately what the Supreme Court says, it has a huge weightage as far as the litigation matters are concerned in the country. Huge stakes are there. Our all eyes on the Supreme Court, what the Supreme Court says.
So,
Because eventually all the notices, if you see now, they have been issued by the jurisdictional.
jurisdictional, everything. And we have a very small client, so we can't go for.
That's why.
That's the
We
issue.
can't file a writ petition. Our stakes are not that much.
That is the issue. So, what is the hope for judgment of at what time it will come?
It's pending still. I mean, it is expected. Actually, it was expected by 15th of August. Now that has not come because some reshuffling of benches and all. But actually speaking, anytime it is expected. So I hope everyone is with me.
Yes, yes, yes.
Okay. So the next very burning issue again is can the assessee be taxed in the year of signing of the development agreement? So when the development agreement gets signed, many of the cases, in many cases, the department tries to tax the assessee in that particular year itself. See, section 45, subsection 5 gets amended, I think from 1/4/2018. Okay, which says that now, as far as the assessees are concerned, when they are getting the consideration at that year, in that particular year, the capital gains are taxable in the year of receipt of consideration. But that is with effect from 1/4/2018. We are talking a scenario before 1/4/2018. So if it is before 1/4/2018, and so many cases are pending which are in fact before 1/4/2018. So what's the defense available for you if your case is prior to 1/4/2018? So our old reliance of the department, it was on Chaturbhuj Kapadia, Bombay High Court judgment, which said that basically in the year the development agreement gets signed, in that year itself the capital gains are taxable. That was decided in Chaturbhuj Kapadia, Bombay High Court judgment, because what court observed in that particular issue, in that particular case, was basically the possession of the land was given in that particular year. So court said that when you are parting with the possession of the land, in that year itself your capital gains are taxable. Now we are referring to basically three important judgment, and one of the most important one is this CIT versus Balbir Singh Maini Supreme Court judgment. Citation is there. So CIT versus Supreme Court is basically on unregistered document. If your development agreement is unregistered, then in that case, whether that unregistered document can have a sanctity as far as the transferring of the rights are concerned, it was on that. But it also deliberated on the development agreement, the exact meaning of the development agreement, and whether the ownership of the land is getting transferred in development agreement or not. So all those issues are very well addressed in this Balbir Singh Maini's case. And then Bharat Jayantilal Patel, again, the Bombay High Court judgment, it talks about the development agreement and the transfer of the development agreement. And when just the rights have been transferred in a particular year, whether the consideration becomes taxable in the hands of the assessee in that year itself, particularly when nothing has happened in that particular year. So just development agreement has been signed, but no activity as such has taken place. Then in that case, whether the capital gains are taxable in that particular year. Then third one is our Mumbai Tribunal judgment, which again said that just because the development agreement has happened in that particular year, if the actual consideration has not been passed, then you can't tax in that particular year. So let us understand these three judgments as far as the Balbir Singh Maini is concerned. It has referred the another Supreme Court judgment, and that is a very interesting comment as far as the Supreme Court is concerned. And I always refer it So it's very, very useful to everyone. So what the Supreme Court has said in this matter, income tax is a levy on income. No doubt the Income Tax Act takes into account 2 points of time at which the liability to tax is attracted. That is the accrual of the income or its receipt. But the substance of the matter is the income. If the income does not result at all, there can't be a tax, even though in bookkeeping an entry is made about hypothetical income which does not materialize. Where income has in fact been received and is subsequently given up in such circumstances that it remains in the income of the recipient, even though given up, the tax may be payable. Where, however, the income can be said not to have resulted at all, there is obviously neither accrual nor receipt of income, even though an entry to that effect might in certain circumstances have been made in the books of account. So this is a comment of the Supreme Court, and I feel it's a very, very important comment. And then further, the apex court, Supreme Court again in Seshasai Steels held that 534 of the Transfer of Property Act would not be attracted in a case where a license was given to another for the purposes of development of the flats and selling the same, and that granting such a license could not be said to be granting possession within the meaning of 53A. So that is why, you know, what the Supreme Court is saying in that Balbir Singh case, ultimately transfer of property is not happening. What you are giving in development agreement is you are just passing on the rights to develop that particular property. You are just giving a license to develop that property, and that is why unless and until you are getting the consideration, the income can't be taxable. And as I said, for that Supreme Court judgment, favorable Supreme Court judgment is there. Favorable Bombay High Court judgment is there, which again said the same thing.
Can you just put on that slide where you have those three judgments? Yeah, just a second.
So we are actually referring to the Pune Tribunal's judgment dated 9th of April 2025. And as I said, this Pune Tribunal judgment also is referring to the three judgments that we just discussed. And again, now coming to the judgment which we are referring, again, that judgment also says that the clause 16 would therefore lead to a position that a license was given to another upon the land for the purpose of developing the land into flats and selling the same. Such license cannot be said to be possession within the meaning of section 53A, which is a legal concept and which denotes control over the land and not actual physical occupancy of the land. This being the case, section 53A of the Transfer of Property Act cannot possibly be attracted to the facts of this case for the reason alone. So then there is, as I said, there is a reference to the Bombay High Court judgment. The assessing officer issued a reopening notice on the ground that capital gains income had arisen to assessee on transfer of the development rights in its land to a developer. Since assessee had merely granted license to permit construction on land on such developer, but not given any possession in land as contemplated under 53A of the Transfer of Property Act, there was no transfer as per section 247 giving rise to any capital gain in the hands of the assessee, and thus the impugned reopening notice was not justified. So this is Bombay High Court in that Bharat Jayantilal Patel's case. So enough jurisprudence, friends, is available as far as this particular issue is concerned. Favorable Supreme Court judgments, favorable Bombay High Court judgment, and the favorable jurisdictional Mumbai Tribunal judgments as well.
These are only for cases before 1/4/2018.
Before
right now law is changed, na?
Yes.
It can be different for tenanted property.
we will come to that just now. So now the next judgment is again relating to the redevelopment itself. So here the issue is whether TDS provisions under section 194(1) applicable in case of transit rent payable by developer in redevelopment. So basically this transit rent, which we call it as hardship allowance. So the issue that we are discussing is the hardship allowance. Now, as far as the hardship allowance is concerned, the hardship allowance gets divided into various types. Sometimes you get it as a corpus, or you get it by way of a rent. So in this particular case, we are talking about rent. So the developer is giving a rent, and whether that particular rent is taxable or not in the hands of the assessees. So that is what we are discussing. So basically, in all the earlier judgments of the tribunals, consistently have taken a view that whatever hardship allowance that we are talking, that hardship is an actual hardship. When a person is living in at a particular place and then he moves out of that place, that is a real hardship. And for that real hardship, he is getting some compensation or some monetary consideration. So that monetary consideration cannot be a revenue receipt, and that monetary consideration has to be a capital receipt. This is what consistently have been held by the various tribunals. Now, that view is confirmed by the High Court. And now the High Court in this case said, in the present proceedings, the term used is transit rent, which is commonly referred as hardship allowance, rehabilitation allowance, displacement allowance, which is paid by the developer or landlord to the tenant who suffers hardship due to disposition. Hence, transit rent is not to be considered as revenue receipt and is not liable to be taxed. As a result, there will be no question of deduction of TDS from the amount payable by the developer to the tenant. So then it has referred the Mumbai Tribunal judgment and then said that those judgments have been approved, and the conclusion is transit rent, which is commonly referred as hardship allowance, rehabilitation allowance, displacement allowance, is not to be considered as revenue receipt and is not liable to be taxed. As a result, there will be no question of deduction of TDS from the amount payable by the developer to the tenant. Now, friends, this is a very, very important judgment because this is our jurisdictional Bombay High Court judgment. Further, in conclusion, the Bombay High Court said the displacement in terms of development agreement is not a revenue receipt, very important, and constitute a capital receipt as the property has gone into redevelopment. In such scenario, the compensation is normally paid by the builder on account of hardship faced by the owner of the flat due to displacement of the occupants of the flat. Said payment is in terms of the hardship allowance, rehabilitation allowance, and is not liable to tax. The case of the assessee is squarely supported by the decision of the coordinate bench in the case of Devesh Lakshmibai Dedia, Mumbai Tribunal judgment, wherein similar issue has been decided in favor of the assessee. So it clearly says that as far as the on transit rent is concerned, the TDS is not to be deducted basically. Unfortunately, see, this is section 194 I. There is another section that is 194 IC, which says which again talks about the compensation. So recently in this return filing season, we came across a scenario where the builders have deducted the tax. I mean, same identical issue. for this the hardship allowance, they have deducted the tax. Now, if the tax is deducted, many a times what happens is to the builders, the chartered accountants, the professionals only are saying to be on the safer side, better deduct the tax. So, but when the high courts are saying that income itself is a capital receipt, so that's why actually there is no question of deducting the tax. Now, if the builders are deducting the tax like which I just discussed, then it's a great issue for that particular assessee. Now, because it has appeared in his 26A statement. Now, as far as section 45(5) that just now we discussed, what it says, ultimately, if at all the income is to be taxable, that income is taxable in the year of receipt of the consideration. Right now, what has happened? Just fag end of the year, the development agreement has been signed in the month of March 2025. I'm real case, I'm telling you. So 31st of March 2025, the development agreement has been signed, and he got that hardship allowance. And on that, the builder has deducted the TDS. Now, the question before me is, where to put that information in my income tax return? Because ultimately, what I'm going to say, first of all, if at all I want to tax it, I cannot tax it in that year because nothing has happened in that year. Section 45(5) doesn't give you any option also that you may tax it in the year of development or receipt. It clearly says if you are an individual, then it is taxable in the year of receipt of consideration. Now, the problem before me is where to put that information, under which section. It's a capital receipt on which they have deducted the tax. Now, the issue for me is where to show that in my income tax return, although the tribunals and the high courts have said that this is a capital receipt. So now I don't know what is going to happen as far as the processing of that return, because it is appearing in 26As. So naturally, based on that 26As, the CPC is will try to tax that income directly. And again, unnecessary litigation, the client may have to suffer.
दो इश्यू होता है, सीपीसी प्रोसेसिंग टाइम टीडीएस जो काटा है उसका इनकम ऑफर नहीं किया तो वो टीडीएस देगा नहीं, रिफंड नहीं देगा, नंबर 1, या फिर वो डिफेक्टिव नोटिस भेजेगा कि आपने इनकम डिक्लेयर नहीं किया.
That's what.
क्योंकि ट्रिब्यूनल का जजमेंट का इफेक्ट रिटर्न में नहीं आता है.
They ultimately, and what law says is different, what portal says is different,
Yeah,
and actually
that is
portal,
that is the
rules than the law.
Portal is more than effective than law.
So it's a problem. Actually, it's a great problem scenario for everyone. I mean, means if you have the clients, builder clients, you have the jurisprudence available. You can guide. If they are deducting the tax, now it's a problem for the tenants.
लेकिन इश्यू क्या है कि इसका जो आप जजमेंट है उसका इफेक्ट आईटीओ लेवल पे कोई मानता नहीं है, पहला प्रॉब्लम. दूसरा, सीए जैसे हम लोग है, अरे हम तुम्हारे क्लाइंट है तो तुम काटो, सामने वाले गए तो बोले मत काटो. दैट इज द प्रॉब्लम. क्या करें बताओ.
So how would you handle it in the return? Let's say if we are the person who has received this.
That's what I mean. And this faceless, no, unfortunately, in our good old days, what we used to do in those days, we used to write a note.
Correct.
So whatever we wanted to say, we used to say by way of a detailed note. Unfortunately, that note concept has gone in this faceless scenario. Now, the great problem is, if I want to show, what I am saying is my income is exempt, my income is not taxable. They have deducted the tax on it. If I am saying my income is not taxable, I have to give a section. Under which section this income is not taxable? What, Vikrant, what do you say?
Yes. And the main challenge is there are multiple validation errors as well. Like you have TDS deducted in IC, so they are even expecting you to report capital gain, which factually is not the case.
So it's a problem for which really we don't have an answer right now.
क्योंकि कैपिटल रिसिप्ट के लिए आईटीआर में कोई कॉलम नहीं है, क्योंकि हमारा अभी एक इश्यू में हो रहा है एग्रीकल्चर लैंड, रूरल एग्रीकल्चर लैंड विच इज कैपिटल एसेट एंड टैक्स फ्री, सो वेयर टू शो, नो शो नथिंग, बिकॉज आईटीआर में कॉलम ही नहीं है कैपिटल रिसिप्ट का।
And in this case, department is very well going to challenge that it is not a capital receipt now because
naturally
TDS
because
has been deducted.
once
TDS has been deducted.
why, how can you say it is, that is the problem.
And CPC will not do anything. CPC is not even willing to.
They
process
will
the
simply
information
write
in the ITR.
अपना rectification right given to you, और ये वो बोलेगा हमारे पास कुछ डिटेल आया नहीं, हम कुछ नहीं कर सकते, that is the problem.
Okay, so but this is a Bombay High Court judgment, our jurisdictional High Court judgment, and of course several tribunal judgments are also there. So whatever issues that we are discussing henceforth, you know, all these issues are our day-to-day issues. Now, this is what has happened and this is what the assessing officer has done, unfortunately.
5 minutes break, ले लो break 5 minutes, हाँ हाँ sir,
We
always have it.
It's fine. So, in case of redevelopment of property, it is very strange, but this is what practically has happened in many cases. That in case of redevelopment of property, whether AO can tax the income under section 56(2)(10), saying the index cost of the old flat is lesser than the stamp duty value of the new flat. As I said, it's a very strange thing what the many assessing officers have done. So basically, what the assessee is getting in case of redevelopment is, instead of his old flat, he's getting a new flat.
correct.
So this is a case, if at all the taxability is there, then the taxability has to be under the head capital gains. If at all the taxability is there, there is no question of having income from other sources in this particular scenario. So that's why the deeming fiction of 56(2)(10), which is applicable basically for income from other sources, can't be made applicable in this case. But strangely, in many assessments, we have seen that the AO has taxed it under 56(2)(10). So the assessee, now I'm directly reading from the judgment, Mumbai Tribunal judgment dated 17th of March 2025. Assessee got a new flat in the redeveloped property in lieu of old flat. Hence, it is a case of extinguishment of old flat, and in lieu thereof, the assessee has got a new flat as per the agreement entered with the developer for the redevelopment of the society. Thus, it is not a case of receipt of immovable property for inadequate consideration that would fall within the purview of provisions of 56(2)(10). Accordingly, we are of the view that provisions of section 56(2)(10) will not be applicable to the facts of the present case. At the most, this transaction may attract the provisions relating to capital gains, in which case the assessee should be entitled for the deduction of cost of the new flat under section 54. In that case, there will be no taxability upon the assessee on account of these transactions. So, if at all, if you have any case where the assessing officer has tried to tax it under 56(2)(10), then the defense is very much available by the jurisdictional Mumbai tribunal itself.
सर ये जो जजमेंट है ना, उसमें एक्चुअली क्या होता है कि आपका फ्लैट समझो 500 स्क्वायर फीट का है, बिल्डर रीडेवलपमेंट में आपको 600 स्क्वायर फीट का देता है, तो ईओ लोगों का मानना है कि 100 स्क्वायर फुट आपको तो फुगट में मिला और बिल्डर आपका रिलेटिव है नहीं, इसके लिए वो लोग 56(2)(10) में एडिशन कर रहे हैं। तो साहब ये हार्डशिप कॉम्पनसेशन में नहीं आ सकता, आपको निकाल के नया दे रहे हैं तो?
नहीं, see, let me tell you, see, first of all, you know, what happens in this case is, or rather what we should do. See, whenever your flat actually is getting extinguished, you know, at that time. Now, again, this is a legal problem. Legally, actually, whenever that flat, the existence of your old flat is coming to an end, the year in which the society goes into redevelopment, your flat is gone, actually speaking. In that particular year itself, now because of that deeming fiction, you need to tax that in the year of receipt. But actually speaking, it is taxable in that particular year itself. What you are selling is actually your old flat is getting extinguished. Okay. In return, what you are getting? You are getting a new flat. So, what is the sales consideration at that point of time? That sales consideration is your new flat that you are getting. Then, what is the cost of acquisition? So, cost of acquisition is in
Your
fact
purchase.
your whatever may be the your purchase price, you are taking it indexation, and then you are computing the capital gains, and then you are saying since I'm investing it into a new flat, so that is why it is exempt under
54,
section 54. So it is not taxable. So that is how, yeah.
सब इसमें रेसिडेंशियल फ्लैट में तो ये चीज मिलता है, कमर्शियल में तो इससे भी बुरा हाल है.
Yeah, commercial there is a problem. Commercial there is a problem because there is no section as such.
You can't get. तो अपना पूरा वो लोग एडिशन करेंगे, एक्स्ट्रा एडिशनल करेंगे, कुछ यही नहीं है.
Commercial में there is a problem. Now this next one, the next case is again a very interesting case. That is when the appellant is the joint owner of two or more properties, can the deduction under section 54F will be available? So let me tell you the issue first. Let us understand this issue. Again, this is a very common issue which is of our day-to-day practice. So basically, as far as the 54F is concerned, the condition is you should not have more than two, na?
One new. You have only one right now, one and one new.
Yeah. So you should not have more than one.
You should not have more than two properties.
Yes. So now the issue that we are talking is if somebody is having more than one, can he avail the benefit of under section 54F when those another properties are jointly held? Not singly held, it is jointly held. I hope I am clear what we are discussing. So these days, anyways, properties are held by husband wife in general. So what the courts have held, this is a very strange scenario, I feel, and the strange judgment as well. So that's why, this issue is very interesting. So I am holding, say, properties. Say I may be holding 10 properties, but then those 10 properties are not owned by me singly, but those are co-owned, jointly owned by with different people. In that case, whether that 54F condition can be applied or not, this is what we are discussing. And very interestingly, now the decisions in favor of assessee. So many judgments are there, including the judgments of our jurisdictional Mumbai tribunal, which have said that it says the section says owned. So owned means the meaning is owned means owned singly. This is how the courts have interpreted very interestingly. As far as the high courts are concerned, the Madras High Court is in favor and the Karnataka High Court is against, saying that no, you can't have it. So basically, now the present date scenario is concerned. The present date scenario here is there are series of judgments which are in favor of the assessee given by the Mumbai Tribunal, our jurisdictional Mumbai Tribunal. Series of judgments are there which says that basically if it is co-owned, then you can't deny the benefit. Now let me tell you why this happens. See, try to understand. that basically, as far as if the department wants to go into the appeal against any of the judgment of the tribunal, then the limits are, our old limits were 50 lakhs for IT-80. Those limits have been increased to 60 lakhs now. Then High Court, 1 crore was the limit, that has been increased to 2 crores. Then Supreme Court, 2 crores to 5 crores. So now, if at all, so many series of judgments have been passed by the Mumbai Tribunal. If at all the department wants to go into appeal, the stakes have to be more than 2 crore. Now, in this scenario, it is not possible to have tax stakes more than 2 crore. So that's why series of judgments have been passed by the Mumbai Tribunal, but none of the judgments have gone into the High Courts. And that's why I feel that whatever High Courts, whatever Mumbai Tribunal has said, that has been sustained. But what I sincerely feel is that can't be the intention of the statute. If you go to the intention of the statute's intention is very clear that if you are already having multiple houses, then that deduction you should not get. That is the intention of the statute. So my question is, can you advise, based on these judgments, can you advise your clients?
Risky, very risky, very risky, very risky.
I hope what I'm saying.
सर लेकिन अभी समझो मेरे पास 2 प्रॉपर्टी है, तो दोनों में जॉइंट नेम है. नॉर्मली सब लोग ऐसा करते हैं, हस्बैंड वाइफ हस्बैंड. तो उसमें ऐसा हो सकता है कि 2 प्रॉपर्टी है, 2 जॉइंट नेम है, तो एक ही हुआ, एक इसका एक ऐसा ट्रीट हो सकता है?
नहीं, I mean, whatever. Now let us see. Let us read what the courts, how the courts have interpreted it, and what the court says. As I said, the favorable court is the Madras High Court. So findings of the Madras High Court held that merely because the assessee jointly owned another property on the date of transfer of the asset, its claim for deduction under 54F of the Act could not be rejected in respect of capital gains earned from transfer of original asset. Then, as I said, the reference is there of the Surat Tribunal, and then a series of judgments of the Mumbai Tribunal. Before us, the learned counsel of the SSC has relied on the following 3 decisions of the tribunal, Mumbai Tribunal benches to support that even if the SSC co-owner is more than one house, since the fractional ownership, very important, since the fractional ownership in a property does not amount to violating the conditions laid down in 54 of the Act, SSC is entitled to benefit under section 54 of the Act. And then there is a reference.
54 में तो one house
54
limit ही नहीं है.
54
54 में तो limit ही नहीं है.
54 yeah, 54.
Now let us assume that intention of the lawmaker, but let us say I am owning 3 house properties along with my wife, and now she has some capital gain out of it from some of other investments or whatever it may be. And now if she wants to have the benefit of 54F, then she will also be denied the benefit. So maybe because of that also.
Yeah, what you are saying is whatever the courts have interpreted is right.
I believe so. I mean, the way our law system is working, that
it's a risky proposition.
Yeah, but I mean, so allowing that also might well be a reason, so that no innocent.
These are all subjective matters. Judgment always are subjective.
मतलब सर ऐसा तो हो ही सकता है ना कि आपने खुद के लिए घर लिया और बीवी का नाम उसमें ऐड कर दिया.
यही प्रॉब्लम है. सब 2 घर है. मैं बताया अभी एक टेनेंसी प्रॉपर्टी है, वो रिडेवलपमेंट में जा रही है, तो फिर अभी 54 का, क्योंकि टेनेंसी में 54F ही मिलेगा, बिकॉज आई एम द ओनर ऑफ द राइट्स नॉट प्रॉपर्टी. तो अभी ठीक है, लड़का है, मेजर है, तो अभी टेनेंसी में तो उसके नाम पे कर दूंगा, अदरवाइज वेरी डिफिकल्ट, टैक्सेबल हो जाए पूरा.
That is another issue. It is not covered in the slides, but as sir said, that suppose that he has the tenancy rights. Okay, he has the tenancy rights, and now that property is getting redeveloped. He is getting a flat. Now that particular flat, he is taking it on his son's name.
Hmm.
So whether the 54F will be available or not. So in that,
Naturally, because
yeah,
center
for
of
that
gravity-
also the series of judgments are there, which have said that this section never says
Ah,
who has brought the property,
Hmm.
and that's why the benefit has to be given in this.
साहब, अभी इसमें भी मैं आपको बता दूं, समझो 2 घर है मेरे नाम पे, मैं एक घर वाइफ के नाम पे कर देता हूँ बिफोर अपना 54F का बेनिफिट, तो वो टैक्स इवेजन नहीं है, इट्स ए टैक्स प्लानिंग, आपको अलाउड है. देयर आर आल्सो सो मेनी जजमेंट, तो ऐसा कर देने का फिर.
Again, here, whether it would be taxable in the year where PAAA is entered into or in the later year when possession is given. Because if we take it in PAAA, then the problem is that 3 years condition in most cases would not be met.
Yeah,
Whether
but
generally is not
we will come to that. But in your case, it is taxable in the year in which, as I explained, no, legally speaking, you are losing those tenancy rights the moment you are vacating that property.
No, in fact, there is Bombay High Court decision that it continues until you get the possession of new flat.
लेकिन
So sometimes development agreement contains a clause that tenant will
No,
continue
but-
to pay nominal
But
rent.
I feel that basically, since in your case, now we will come to those decisions also, where the courts have held that conditions prescribed in 54, we will decide, we will discuss on that also, that conditions prescribed in section 54 can't be fulfilled, practically speaking, in a city like Mumbai, where the construction never happens in 3 years. We will come to that.
big billing is
So
possible.
that's why, so long as by and large the assessee has complied with the provisions, then you have to give the benefit.
Ultimately,
So
तुम्हारे हाथ में कुछ है ही नहीं, तो तुम मतलब हो गया अंडर कंस्ट्रक्शन.
we will come to that. We will come to those decisions as well.
का एक कंडीशन लेना पड़ेगा, क्योंकि रजिस्ट्रेशन ऑल डिटेल्स गोज डिपार्टमेंट के पास PAAA का ही होगा, बाद में 3 साल का कहाँ से वो वेरीफाई कर.
Now we are referring to Supreme Court judgment in case of an internal reconstruction. So academically, we all have learned the internal reconstruction. So where you have the shares, but ultimately you lose those shares in a scheme of internal reconstruction. You have submitted, company has submitted a scheme to the High Court, and the High Court approves the scheme. And as per that scheme, your number of shares get reduced. So in that case, whether it amounts to the transfer, obviously, in this case, you are losing big time. It's a huge loss for you. Now the question is whether you can claim that capital loss. That is the issue. So that issue went up to Supreme Court, and Supreme Court categorically has held that this loss is a real loss. It's not a notional loss, and that is why this loss has to be allowed. So this is the Supreme Court judgment. Again, recent judgment, that is 2nd of January 2025. So I will just read from the judgment. Reduction in number of shares held by the assessee on reduction of share capital of the company. Pursuant to a petition by the company, the High Court order for a reduction in the share capital of the company from 15,35,000 odd shares to just 10,000 shares. Consequently, the share of the assessee was reduced proportionately from 15 lakhs to 9,000 shares. Though the face value per share remained the same before the reduction of share capital, and after reduction, it can be said that on account of reduction in the number of shares held by the assessee in the said company, the assessee has extinguished its rights of 15 lakh shares, and in lieu of that, it received 10,000 shares along with a specified amount. Reduction in share capital of the company and subsequent proportionate reduction in the shareholding of the assessee is squarely covered within the ambit of the expression sale, exchange, or relinquishment of the asset used in section 2 subsection 47. Therefore, the assessee is entitled to claim long-term capital loss, which is accrued on the reduction in the share capital from the sale of shares of such company. Section 2 subsection 47, which is an inclusive definition, inter alia provides that relinquishment of an asset or extinguishment of any right therein amounts to a transfer of a capital asset. While the taxpayer continues to remain a shareholder of the company, even with the reduction of share capital, it could not be accepted that there was no extinguishment of any right of his right as a shareholder qua the company. Company under section 66 of the Companies Act 2013 has a right to reduce the share capital, and one of the modes which could be adopted is to reduce the face value of the preference share. When, as a result of the reducing the face value of the share capital is reduced, right of the preference shareholder to the dividend or his share capital and the right to share in the distribution of the assets upon liquidation is extinguished proportionately to the extent of reduction in share capital. Such a reduction of the right of the capital asset clearly amounts to a transfer within the meaning of section 2 subsection 47, and then the conclusion is reduction in share capital of the company and subsequent proportionate reduction in the shareholding of the assessee is squarely covered within the ambit of the expression sale, exchange or relinquishment of the asset used in section 2 subsection 47, and therefore after the reduction of share capital, the assessee is entitled to claim the long-term capital loss which accrued on the reduction in share capital from the sale of shares of such companies. So this is a very nice Supreme Court judgment. Unfortunately, I feel that way it's a simple matter, but still it went up to the Supreme Court, and then the final judgment came from the Supreme Court. Next issue is again a very simple issue, but again a very practical issue. So as far as the tolerance band of 10% for 43CA, that is with effect from 1st of April 2020. So whether it is 43CA or 56(2)(10, so whether the tolerance band of 10%, whether it is prospective or retrospective, that is the issue. So if you remember earlier, that tolerance band was 5%, and now that got increased to 10%. So this is again a very recent judgment of the Mumbai Tribunal dated 29th of April 2025. Which says that there are series of judgment, in fact, which have held that this is a beneficial provision, and when it's a beneficial provision, the effect has to be retrospective, as has been held in series of judgments of various tribunals in the country, and same is confirmed by the Mumbai Tribunal as well. So tolerance band introduced under section 43CA of the Act, that is 5% with effect from 1st of April 2019 and 10% with effect from 1st of April 2021, is applicable to assessee's case for assessment year 17-18. Provisos which was introduced by the Finance Act 18 provided that if the difference is not more than 5%, then the actual sale consideration will be treated as income. In other words, no addition will be made if the difference is within the tolerance band of 5%. Said 5% was increased to 10% by the Finance Act 2020 with effect from 1st of April 2020. Proviso to section 43CA providing relief to the assessee to the extent of the difference being less than 10% is applicable retrospectively for the reason that it is a beneficial provision, as has been held by the Supreme Court. When the reason behind the introduction of the proviso is the ratio laid down by the judicial precedents on the retrospective applicability of the beneficial provision, there is no hesitation in holding that the tolerance band of 10% is applicable in assessee's case for 17-18. In assessee's case, the difference between the DVO valuation that is considered for making addition under 43CA and the sale consideration is less than the tolerance band as per the proviso to the said section. Accordingly, that in assessee's case, no addition under section 43CA is warranted for the year under consideration. And then series of judgments have been given, which all have held that this has to be retrospectively and not prospectively. Now, the next issue is our section 44 AD. So, whether addition on account of bogus purchase will sustain where the income is offered under section 44 AD. So, that is the issue that we are discussing. So, the tribunal is saying that under section 44 AD, he is not required to maintain books of account as well as the details of purchase made. This is relevant till the total turnover. This is very important. This is relevant till the total turnover of the assessee does not exceed the prescribed limit under section 44 AD. Merely on the basis of the information received from the GST department, AO made disallowance without making any inquiry about the purchases. And therefore it is not justified. Assessee provided complete details of address and GST number of that party. AO did not gather any evidence on his own for making the addition. Purchases do not have any nexus. Now this is very important again. Purchases do not have any nexus with the gross receipts, as gross receipts shown by the assessee remained undisputed and was never contested by the revenue to the beyond beyond the specified limit, and therefore the impunged addition is deleted. So basically, the tribunal is clearly talking on the receipts. Then further, in the concluding para, it has said, the learned AO merely on the basis of the information received from GST department made disallowance without making any inquiry about the purchases from the authorized representative. Assessee has provided complete details. Thus, it is clear that the learned AO merely relied upon the information furnished by the GST department and did not gather any evidence on his own for making the addition. Further, the decisions of the Honorable Punjab and Haryana High Court and the coordinate benches specifically cover the issue in favor of the assessee. Honorable High Courts have held that the assessee was not under an obligation to explain individual entry of purchases unless such entry has nexus with gross receipts. In the present case, the purchases do not have any nexus with the gross receipts, or gross receipts shown by the assessee remained undisputed and was never tested by the revenue to be beyond the specified limit. Therefore, respectively following the Punjab and Haryana High Court, I direct the AO to delete the addition. I think, Vikrant, this is what you were telling as far as the 44 AD is concerned. The emphasis here is on receipts. So, the receipts, they are not checked at all, whether they are correct or not. And then if you have not checked the receipts, and then for the expenses you are making the addition, then several tribunal decisions are there which have held that you can't make addition that way. Now, next issue again is very relevant and very important one. MIDC properties, whether 50C provisions applicable for MIDC properties. Now, let me give you the background. See, earlier, as far as the MIDC properties are concerned, the Mumbai Tribunal decisions were in favor of the assessee, saying since these properties are leasehold properties, the 50C provisions are not applicable, and therefore everybody was happy that way. But now I think this is the only judgment which is which we are discussing, which is in favor of the revenue. All the judgments that we discussed, were in favor of the assessee. Now this is the judgment which is in favor of the revenue. It's again a Bombay High Court judgment, recent one, again 1st of April 2025. Vidarbha Lanier Industries, the High Court of Bombay, Nagpur bench. So now what the courts have held, the words used, perusal of the definition of the capital asset as contained in section 2 subsection 14 would indicate that it includes property of any kind held by an assessee. What is material to note that the expression is held by an assessee and not owned by an assessee. Insofar as the immovable property, that is land or building, is concerned, there are a number of ways in which it can be held. The holding can be either as an owner, lessee, sub-lessee, allottee, tenant, licensee, gratuitous licensee, or any other mode permissible or recognized by law. The expression held by an assessee therefore does not restrict the manner in which the land or building can be held. Holding of land is merely a method in which rights of the land can be held or acquired by a person that cannot be in any manner equated with land or building, but rather would be a species of that right to hold it, which, as indicated above, are of multiple nature. Therefore, merely because the land was originally allotted by the MIDC by way of a lease to the predecessor of the assessee, who in turn has received the same by way of assignment, that being one of the modes of transfer of land and building, mere use of a particular mode of transfer cannot create any expression vis-a-vis the holding of the land or building by the assessee. Word transfer as used in 50C1 also cannot be used in a restricted sense and will have to be given a widest amplitude considering the nature and the purpose of the section, and thus would include all modes and methods of transfer as are permissible and recognizable in law. And here they are saying Atul Puranik versus ITO, the Mumbai tribunal judgments have been distinguished. And they are coming to a conclusion that basically, although these are MIDC properties, the 50C is very much applicable.
पहले लीज होल्ड टेनेंसी राइट में 50C नहीं था, तो अभी इसमें आ गया तो टेनेंसी राइट में भी 50C एप्लीकेबल होगा.
Yes, that's what this, and they have mentioned also, as far as the lease are concerned and the tenancy is concerned, that is also mentioned here. I think now next is on that 54 again. As sir was mentioning, if the construction is not completed within 3 years, still whether the exemption under 54 is available or not.
Yes, because construction is not in our hand.
Yes.
You have paid full amount, 80-90%, then allowable.
So again, Mumbai tribunal judgment. Now, just see the comments given by the Madhya Pradesh High Court. During the hearing, the learned authorized representative placed reliance upon decision of the Honorable Madhya Pradesh High Court, wherein the Honorable High Court held that completion of construction and handing over the possession within the time prescribed under 54 of the Act is impossible and unworkable. The Honorable High Court further held that if substantial investment is made in the construction of the house, then it should be deemed that the sufficient steps have been taken, and this satisfies the requirement of Section 54 of the Act. Relevant findings of the Honorable High Court in the aforesaid decision are reproduced as under. This clinches the matter and was not proper for the tribunal to have ignored the circular because it has a persuasive value, and it was in the nature of granting relief. Therefore, the tribunal should have considered the circular sympathetically and granted the relief. More so, 54 of the Act only says that within 3 years, the assessee should have constructed the house, but does not mean that the construction of the house should necessarily be complete within 3 years. What is within 3 years? What is mean is that construction of the house should be completed as far as possible within 3 years. In the modern days, it is not easy to construct a house within the time limit prescribed under the government schemes. Construction takes years and years. Therefore, confining to 3 years period for construction and handing over the possession thereof is impossible and unworkable. So these are the comments of the High Court, and that's why, for our better understanding, I am just reading direct from the orders. So we will come to know exactly how the courts are interpreting the provisions. What I can do is, I will just give all these PDFs to you.
Yes, yes.
So these PPT anyway, is there any of you want, I can share that. And in addition to that, what I can do is I will just share all these PDFs, whatever today we have discussed, all those PDFs I can share so that you will have those PDF handy.
अभी जो पढ़ा हो अभी तो याद रहेगा नहीं, जब केस का जरूर पढ़ा दो.
Yes. Now, any of you, if you are dealing with a case of credit cooperative societies, then this particular judgment is very much relevant and very much important. So first of all, let me give you the background. So we will finish it in 15 minutes. It's fine, no? Okay. So let me give you the background first. So basically, as far as the credit cooperative societies are concerned, two sections we talk, that is ATP 2AI and ATP 2D.
2D, correct.
As far as ATP 2AI is concerned, the credit cooperative societies, that is PATPEDs, which we call. So in case of these credit cooperative societies, income from business is fully exempt under section ATP 2AI. Income from business of a credit cooperative society is fully exempt under section ATP 2AI. There is another section which we deal with reference to cooperative society. Maybe in case of our housing societies also. So that is ATP 2D, because it says that any cooperative society, if the income is received from another cooperative society, then that income is exempt from tax under ATP 2D. But that ATP 2D, basically the deduction is available for income from other sources. And as far as ATP 2AI is concerned, the deduction is available only for income from business. So you're getting the difference. So ATP 2AI, when we say it is for income from business, and when we say ATP 2D, it is basically income from other sources. Okay. So as far as the ATP 2D is concerned, income from other sources. So just like in case of housing societies, our housing societies are investing with cooperative banks. Why? Because basically for first, cooperative banks are cooperative societies, and therefore the deduction is available under ATP 2D. So for that also litigation is going on every day. We are fighting the cases in tribunal for this ATP 2D issue. As far as ATP 2AI is concerned, the matter went up to Supreme Court, and Supreme Court said, yes, as far as the credit cooperative societies are concerned, the income from business is fully exempt from tax under section ATP 2AI. So this is the legal position. Now, the case that we are discussing, it's a very peculiar case where the credit cooperative society, as far as the interest income is concerned, interest income of a credit cooperative society. So two sections we discussed, one is ATP 2AI and then another is ATP 2D. So as far as the credit cooperative society's interest income is concerned, the debate is on that interest income. Whether that interest income earned by a credit cooperative society, whether that income is income from business or income from other sources. So that issue we are deliberating. In this particular case, argued by me only, the income was from nationalized banks. Interest income was from nationalized banks. So when that interest income was from nationalized banks, that can be claimed as exempt under ATP 2D, because ATP 2D is only for credit cooperative societies. So that's why the line of argument taken by me was basically, look, this is a credit cooperative society. It is accepting the deposits and then it is giving the loans. Meanwhile, the money is kept with the banks. So naturally, whatever I am doing is a part of my business operations. And that is why whatever interest income that I am earning is my income from business and not income from other sources. So this is what I argued, and this is what the judgment is. So it is held that interest income from amount kept with bank is a part of the business income of the assessee, and income so derived is the profits and gains of business attributable to the activity of carrying of business of providing credit facilities to its members by a cooperative society, and is liable to be deducted from the gross total income under section ATP and also allowed under ATP 2AI of the Act. We have perused the decision of the ITAT Mumbai. Those decisions have been given, and then very important para. Therefore, the word attributable to is certainly wider in import than the expression derived from. Whenever the legislature wanted to give a restricted meaning, they have used the expression derived from. The expression attributable to being the wider import, said expression is used by the legislature whenever they intended to gather receipts from the sources other than the actual conduct of the business. A cooperative society which is carrying on the business of providing credit facilities to its members earns profits and gains of business by providing credit facilities to its members. The interest income so derived or the capital, if not immediately required to be lent to the members, they cannot keep the said amount idle. If they deposit this amount in bank so as to earn interest, said interest income is attributable to the profits and gains of the business of providing credit facilities to its members only. The society is not carrying out any separate business from earning such interest income. Income so arrived is the amount of profits and gains of business attributable to the activity of carrying on the business of banking or providing credit facilities to its members by a cooperative society, and is liable to be deducted from the gross total income under ATP 2D. The amount which was invested in banks to earn interest was not an amount due to any members. It was not the liability. It was not shown as liability in their account. In fact, this amount, which is in the nature of profits and gains, was not immediately required by the assessee for lending money to the members, as there were no takers. Therefore, they had deposited the money in a bank so as to earn interest. Said interest income is attributable to carrying on the business of banking, and therefore it is liable to be deducted in terms of section ATP 21 of the Act. So accordingly, the benefit was given. But just like that 54F thing, which we discussed, here also the two high courts in the country are of the view that this particular income can't be taxable under income from business. It has to be income from other sources. Two high courts are of the view that it is, as I read, it is attributable to business, and therefore this income is taxable under the head income from business. See, whenever, now this is again a legal proposition, whenever the high courts, two high courts in the country are having a divergent views, and then in that case, as far as the tribunal is concerned, it has referred vegetable products judgment in series of cases where the proposition is, in this case, if the high courts are having divergent view, the view that is favorable to the assessee has to be adopted. So and considering that fact, always the relief is given. In many other cases also, just like that, I think 54F judgment also, high courts are of divergent views. Two high courts in the country have different views. But when in that case, and then a jurisdictional Bombay High Court judgment is not available. If the jurisdictional High Court judgment is not available, then the view that is favorable to the assessee has to be taken. This is a legal precedent which is followed always in the tribunal. For that also case law is there, and it is there in the judgment also.
Mumbai High Court judgment is not available, then favorable. If Mumbai High Court judgment is against us, even though that has to follow.
Yes, because it's a jurisdictional high court. So I hope this is clear. The issue of credit cooperative society. Then last one, the penalty under 270A. See, first, let me tell you the history as far as the concealment penalty is concerned. Our old section was 271(1)(c). So, the wording of the section 271(1)(c) was such that after the Supreme Court judgment came in case of Reliance Petrochemical, it became very clear that no penalty order of the department will sustain. So everywhere you see in all the case, in all the cases under section 271(1)(c) that have been thrashed by the tribunals and the high courts, because after that Reliance Petrochemicals judgment, and that is why then the government felt that now this 271(1)(c) section has no meaning to us, and that is why they brought a new section, and that new section was section 270A, where they tried to make it watertight. In a sense, the penalties are going to be levied irrespective. The way that section is worded, it is like they are going to levy the penalty whenever your returned income is less than your assessed income. So that is the scenario. So as far as that section 270A is concerned, that 270A, now this is again very important, because this is the only way I feel you can get away with the penalty. That's why let us just see what that section 270A says. So this section 270A, penalty for underreporting and misreporting of income. So this 270A, this particular section also has number of subsections, 1, 2, 3. So many are there, 4, 5, 6. Total 11, 12 subsections are there. And then various subsections basically deal with different situations under which the penalty has to be levied. Now, in all the show cause notices, if you see, and in the assessment orders also, the 270A notices, they are not writing the subsection. They are just writing 270A. They are just mentioning 270A. They are not mentioning specifically under which clause they want to levy the penalty. So whenever they are issuing a show cause notice, they are supposed to give you that information under which subsection they are levying the penalty, which they are doing, which they are not doing. So that is the point, or rather, I feel that is the only point on which you can defend your 270A penalty. And again, for this also, I am referring to the Pune Tribunal judgment of dated 26/12/2024. But Mumbai Tribunal judgments on this issue are also very much available, which says that if the AO is not giving you that information in the show cause notice and in the assessment order also, then no penalty can be levied. So series of decisions are there wherein the courts have held that if you are not giving that information, then you cannot levy the penalty.
Specific limb is important.
Yes.
By way of section or by way of wording?
Let me read. The various other decisions relied by the learned counsel also supports his case to the proposition that where neither the assessment order nor in the notice issued under 274 read with section 270A, the assessing officer has specified as to under which limb of provisions of 270A2 or 270A9 the case of the assessee falls. then in that case, no penalty under section 270A is leviable. We therefore uphold the order of the learned CIT appeals, and grounds raised by the revenue are dismissed. Then another issue here is, in this particular order, the income was estimated. Means the assessee has offered the income on percentage basis. The AO, suppose it was 7% or 8%, AO increased, it was its estimation of income. And in that estimation, AO raised it to say 10%. So earlier income offered was also on estimated basis. AO also have done the estimation only, but he increased from 8 to 10%. So in that cases also, on that now this is a legal ground, but on factual position also, on the facts also, as far as 270 AC, our old penalty provisions, our old penalty provision is concerned, the court have held that when the AO himself is estimating the income based on percentage, then you cannot levy the penalty. And in this judgment also, the tribunal further held that even otherwise also, means this is on technical ground, but on merits also, even otherwise also, it is an admitted fact that profits of the assessee has been estimated by resorting to the provisions of section 145(3). It has been held in various decisions that penalty under section 271 1C of the Act is not leviable when the profit is estimated. Same corollary, in our opinion, is also applicable to the provisions of section 270A of the Act, and therefore the penalty is deleted. So I feel for penalty, we all have, this is the only ground, whereby we can challenge that penalty. So with this, friends, we are coming to the end of my presentation. See, as I told as I told you in the beginning, it's a big challenge that keep ourselves updated as far as the case laws is concerned, and I'm having this passion of sharing the case laws monthly. I do share it. So any of you wants to connect with me, you can. My mobile number is there. My email ID is also there. Any queries, if you have, you can mail me, and on WhatsApp you can connect with me, so that I will add you in my broadcast list, so that you will get the monthly updates as far as the direct taxes are concerned. So thanks to WRC Chairman Ketan Sayyaji and the entire team of WRC for giving me this wonderful opportunity. Thanks to all the direct tax study group members for giving me very patient hearing, and I thank my partner CA Vikrant Joshi for helping me in this presentation.
How can we get these the presentation and the PDFs? Right now we have extra copy.
So you can.
You have copy?
I will mail it to WRC, and then otherwise also, if you can ping me on personal WhatsApp, I will mail you.
Okay.
Presentation anyway is there with you. Copies I want, I can share you. Yes, I will share the PDF. Thank you.
Thank you.
Okay.
Thanks.
Nice presentation.
Yes. Topics आपले हे झालेले आहेत. विचारच नाही काही करतो. ऑनलाईन पण होतो पाहिजे. ते काय आपल्याला समजेल. असं आहे का? बरं झालं असेल आता. लोक काय आपण खातोय ते बघ. व्यवस्था तर सांगू पण शकतो ना आपण ब्रेकफास्ट ऐकलं. लोक अजून ते म्हणतात की बाबा 5 मिनिटं खाल्ली आणि 15 मिनिटं आज पुढे येते. आपल्याला हे नाटक पण कुठे वाजवता येईल. हे नाटक तर इंटरेस्टिंग आहे ना. तर ते वेदांग तुम्हाला दिलं ते मला त्यांना देऊन काही कॅमेरा तिकडे. त्याने मला लिहिता येतं. पैसे दिले म्हणून मी म्हणलं चुकीचा व्यवहार. कॅमेरे वगैरे नाही. ठीक आहे. काय माझ्या वेळी तू ह्याच्यात